A few weeks ago, I was chatting with a prospective new client, and he said, James, I spend a lot more of my time than I would like thinking about my money and whether it's invested correctly, because I find myself going around in circles. There's just so much information out there and so many options to choose from. I understand the basics, your stocks and your bonds, but what confuses me is all these other things that you can invest in. Commodities, real estate investment trusts, alternatives like hedge funds and private equity. You never really talk about these things in your videos, but from the reading that I've done, it seems that rich people tend to invest heavily in these things. And given that they're so rich, they must know what they're doing, right? So my current train of thought is, why don't I just copy them? This is a really good question. I have worked in wealth management for 12 years, and I can tell you that really wealthy people with tens or hundreds of millions, tend to invest their money in a completely different way to the average investor. So what is it that these wealthy people know that everyone else doesn't? And why aren't more people copying them? Well, in the past, the main reason was that small investors were not able to access these types of investments. They were only available to large investors. But now that is starting to change, and there are platforms and funds that allow retail investors to access many of the tools that wealthy people use. So now, for the first time, there is the ability for people like you to copy how the wealthiest invest their money. But the question that we're going to answer today is, should you? The first thing that we need to understand is, what are wealthy people investing in, and how does that differ from the average investor? When thinking about building an investment portfolio, there are three main building blocks. You have stocks, bonds, and cash. For the average investor, it's likely that their investment portfolio will consist of some combination of these three. In 2020, Vanguard produced a report on the 5 million Americans that use their platform, which showed that the average investor has a portfolio of 65% stocks, 25% bonds, and 10% cash. Although this did vary greatly depending on their age, starting off with higher allocations to stocks when they're younger and then declining as they get older, as you might expect. The median account balance was $60,000, so I think this is a pretty good proxy for what the average investor's portfolio looks like. But how then do the wealthiest invest their money? Each year, JP Morgan surveys ultra-high net worth families from across the world to understand how they invest their money. And they found that on average, they allocate 8% to cash, 12% to bonds, and 26% to public stocks. So they have less than half of their money invested in these traditional asset classes that normal investors use. A tiny amount in commodities and infrastructure, but the largest allocation by far is to alternative investments. Breaking that down, they have 17% in private equity, 15% in real estate, 5% in hedge funds, 5% in venture capital, and 4% in private credit. And it's not just wealthy individuals that invest in these types of things. US endowment funds, some of the largest pools of capital in the world, typically have high allocations to these alternative asset classes. So the question is, why are they doing this? These are some of the wealthiest people on the planet who have access to the best investment advisors. So what do they know that other people don't? We're going to take a look at each of these asset classes to understand why these people are using them and whether you should be too. But to understand why they're doing this, we first need to go back to Portfolio Construction Theory 101. Investing is not just about trying to get the best possible return. It's about trying to deliver the best possible return for a given level of risk. Over the long term, stocks tend to deliver higher returns than bonds, but stocks can be extremely volatile. With a diversified portfolio, you might expect that at least once a year, it might fall by 10%. Every 5 years, it could fall 30%, and once in a generation by 50%, if not more. Now, not everyone can stomach a roller coaster like that. So if you're looking for a smoother, less painful investing journey, in theory, you can blend stocks and bonds together to build a portfolio that you're more comfortable with. But this is the thing. Although the return for this 50-50 portfolio would be the sum of its parts, because stocks and bonds are not perfectly correlated with each other, the volatility of the portfolio would be less than the sum of its components. And in theory, if you continue to add other less correlated assets into your portfolio, it can reduce the risk even further, which means that you can now actually achieve a much higher return for the level of risk that you're willing to take. This is why adding alternative asset classes to your portfolio can help to reduce risk and enhance returns, in theory. But do they actually do what they say on the tin? And if so, should you be using them? Let's start with real estate. This is the odd one out because it's the only one where the wealthier people get, the less of it they tend to own. And this is because the average investor typically has between 50 and 90% of their wealth tied up in their homes. I don't think you should think of your home as an investment, but most people do. And from that perspective, having the vast majority of your wealth tied up in a single, often highly leveraged house on a single street in a single city is actually a pretty high-risk position to be in. The reason people tend not to recognize this is that you can't see the value of your home fluctuating on a daily basis like you can with stocks. It also means that you're sitting on a lot of capital that could be working for you elsewhere. So one of the first things that wealthy people do is to diversify beyond their homes into other asset classes. Even within this 14% property allocation, there will be a lot of diversification. Some of this will be homes, but there's also going to be direct commercial property and property funds. The challenge with directly investing into commercial property is that it requires domain expertise, a lot of capital if you want to be diversified, and it's illiquid. Wealthy people obviously have access to a lot of capital, expertise, and liquidity tends not to be a problem because they also tend to have a lot of other money invested into highly liquid stocks and bonds, which means that they can afford to tie up other parts of their portfolio for the long term. These are all things that the average investor tends not to have. Property funds, however, can give you instant diversification by allowing you to own a small slice of a property portfolio. However, as we see from time to time in the news, these funds often have their own liquidity issues, meaning that you may not be able to get your money out when you need it. Real estate investment trusts offer a solution to this because they are closed-ended funds that are listed on a stock exchange, making them highly liquid and an accessible way for retail investors to get access to a diversified property portfolio. But should you? It's a personal decision, but firstly, if you do, it's really important that you pick a good fund, which is always hard to do in advance. And secondly, if you already have so much money tied up in your home, does it really make sense to invest in even more property when you can get better diversification elsewhere? The other thing that wealthy people tend not to invest in is commodities, mainly because a lump of gold will always be a lump of gold. It does not produce an income, and there is no management team trying to turn it into 2 lumps of gold. Although arguably commodities can be useful for inflation protection, wealthy people prefer to get that protection via investing in productive assets like businesses. And for downside protection, they prefer to use things like hedge funds. But before we get into them, let's first talk about private equity. These are holdings in private businesses that do not trade on a stock exchange. Businesses like SpaceX, Revolut, or anything down to just a small chain of dry cleaners. In theory, private companies should have higher expected returns than public companies because they tend to be smaller, have a higher chance of failure, and are illiquid. They are very hard to sell, and investors should demand higher returns for these additional risks. However, unlike with public companies, there is no index that you can invest in that will give you exposure to all private companies and capture the average return of the sector. Instead, you have to invest directly into individual companies yourself or through actively managed private equity funds, of which there are 2 main categories: venture capital, which focuses on small early stage companies, and buyout private equity funds that invest in larger, more established businesses. One of the reasons people like private equity is that, just like the value of your home, because this stuff is not valued on a regular basis, it can give off the illusion that it's a lot less risky than it actually is. But the reality is that most businesses make terrible investments. In general, venture capital funds expect 6 out of 10 of the companies that they invest in to go bust within the first 5 years. So a complete loss of capital. They expect 3 out of 10 to survive, and when they are finally able to sell their shares, which might not be for 5 or 10 years, they hope to break even. And they expect just 1 out of 10 to actually come good and hopefully deliver a return that makes up for all of the other losses. When it comes to investing directly into private businesses, there is a high chance that you could lose all of your money. To understand why wealthy people are often comfortable with these risks, we need to zoom out and think about who they are. Firstly, the vast majority of wealthy people did not make their money by investing in a diversified way. Most of them made their money by starting businesses. So these are people who are often not only very comfortable with those risks, but they then have a network of connections to help find opportunities to invest, and they have a skill set to not only vet those businesses, but in many cases add value to them. Wealthy people can also afford to take much higher risk than the average person. For example, imagine if you were in a position where you could say with confidence that you only need 50% of your investments to sustain your family's quality of life moving forward. You'd probably invest that 50% in traditional, lower risk, highly liquid assets, which means that you're then free to take a lot of risk with the rest of your portfolio and tie it up for the long term in the pursuit of higher returns. This is one of the reasons why it is so dangerous to blindly copy the investments of other people. Whether this is someone that you found on YouTube, a famous investor like Michael Burry, or just a mate in the pub. Before copying them, not only do you need to understand why they are making that specific investment, but more importantly, how it fits in with the rest of their portfolio and how they think it is going to help them achieve their specific goals. Because the chances are that either they have not thought about it properly themselves, or your goals and objectives will be very different to theirs. And if you copy them, you might end up using a sledgehammer to knock in a nail. These are the reasons why directly investing into private companies is not suitable for the vast majority of people. But what about private equity funds, where you have a management team that will do all of this for you? In the past, these funds have only been available to wealthy investors and institutions that are looking to invest large amounts. Because think about it, if you're a fund manager trying to raise money for your fund, would you rather take that money from a small group of knowledgeable investors or thousands of retail investors who are going to ask a lot of basic questions and create a lot of admin? But nowadays, there are platforms that allow retail investors to access funds like this. So the question is, should you be using them? Well, firstly, private equity funds are still very high risk. They are illiquid, so you may not get your money back for 5 or 10 years, and they tend to have very high fees. A 2020 study reported that the average fees for a private equity fund was the equivalent of 6% per year. That is why private equity is known as the billionaire factory, because these managers make so much money for themselves. But what about their investors? Ultimately, fees are irrelevant if the performance is still good. And there is evidence that private equity funds have, in aggregate, outperformed public market stocks in the past. However, there is a huge amount of dispersion within those results, with one study finding that the top performing quartile of funds would have left you the equivalent of 81% better off than investing in the S&P 500 over their lifetime, which tends to be about 5 years, whereas the bottom quartile would have left you down 32%. For venture capital, it's even wider, with the top quartile outperforming the S&P by 111% and the bottom quartile down 57%, which shows just how important it is to make sure that you invest in a good fund. But this study also showed that of the private equity managers whose previous fund was in the top quartile, only 34% of them went on to raise another fund that was in the top quartile, showing that, as ever, when it comes to actively managed funds, past performance is not a reliable indicator of future results. So how are you supposed to identify a good fund in advance? A well-known saying is that the only way to find a good private equity fund is to find one that won't take your money. Because the best funds tend to be small and so exclusive that even extremely wealthy people struggle to get into them. So clearly, investing in private equity is high risk, produces unpredictable returns, and is difficult for retail investors to access. However, in the UK, the government offers generous tax incentives to retail investors to encourage them to invest in small, innovative businesses. And these schemes make investing in private companies more attractive and accessible. So there are certain situations that I do recommend these types of solutions to my clients, but it is still only ever for people that are comfortable with the risks, people that already have a large amount of liquid assets, and even then would only be looking to invest up to 10% of their overall portfolio into these higher risk investments. Now, what about hedge funds? Hedge fund is a term used to refer to a wide variety of different funds, some of which are designed to deliver returns that are less correlated with traditional stocks and bonds and can help to diversify a portfolio, whilst others tend to be absolute return funds that use tactics like short selling to try and produce positive returns no matter whether markets are rising or falling. It's hard to make generalizations about hedge funds because there are so many different use cases. However, the one thing that seems to be consistent is their high fees. Most hedge funds charge a fee of 2% per year plus a 20% performance fee. But a fascinating paper found that investors actually end up losing about 50% of their returns to performance fees. Hedge fund investors typically invest in more than one fund. And as an example, over a period of time, some of those funds may do well and you'll pay performance fees there, and others won't perform well. But from your perspective across your whole portfolio, you may end up paying away much more than 20% of your gains in performance fees. And what kind of performance should we expect? Here we have the risk and return of publicly traded US stocks, bonds, and a 60-40 portfolio over the last 20 years. And here is the average performance of the hedge funds in each of these categories. So you can see that the return characteristics are not that dissimilar from bonds. Of course, there will be some funds within these groups that have performed better, and this is not enough information to dismiss hedge funds entirely. But this is the thing. Alternative investments as a whole are often high risk, they have high fees, and they are complicated as hell. So for us retail investors to even think about investing in this stuff, there would need to be some very clear, compelling advantages. And there isn't, even for wealthy people. In fact, I believe that the reasons why the wealthy end up investing in this stuff are often irrational. Let's say you're someone like Roger Federer, someone who comes from a world where the more skillful you are and the more effort you put in, the better the results that you get. When Roger goes looking to invest his money, he's not likely to want to settle for the average return of an index fund that any man on the street can get. He's going to seek out the best, most exclusive, often most expensive investment advisors who will offer him up these complex solutions. And smart people like Roger love nothing more than complex solutions. But in reality, investing is counterintuitive, and it's typically the most simple, lowest cost solutions that are the easiest to stick with that provide the best results. So in my opinion, a simple, globally diversified, low-cost stock and bond portfolio should get you 95% of the way there. The rest of this stuff is just icing on the cake and is best ignored.